Welcome to our Opportunity Zone Week kickoff with an in-depth look at the Opportunity Zone regulations with the founder of Anderson Business Advisors, Clint Coons, who has been helping so many of our members with asset protection and including Real Wealth Network. So we're extremely grateful for his expertise and wisdom in that area, and also with the tax planning part of the business, because you got to get the entity structure and the tax part straightened out in advance before buying that asset. So we're very, very excited to have so many people registering for this. We're excited that some more regulations have come out so we could be more confident moving forward. And as I had kind of mentioned right before we started this broadcast, I think we're the only ones who are out there teaching people that they can do this on their own. I mean, yes, you can invest in somebody else's opportunity zone fund. And if you find a great fund with a really experienced operator, good for you. But unfortunately, there's a lot of people coming into this industry because of the new regulations or because of the new tax incentive who aren't necessarily experts in real estate. So you've got to be really careful when investing in somebody else's fund, but why not do your own? So again, we're excited to be hosting Opportunity Zone Week here at Real Wealth Network, starting with today, going over it. This might go a little long, by the way. It might go about an hour and 15, 20 minutes because there's so much information, so important to understand the asset protection and how to structure it and the tax benefits and all that before you invest in anything. So we're kicking it off with that. And Clint has an amazing ability to simplify a very complicated topic. So we're going to be experts at the end of the hour. That's my intent. And if you're not, well, it's recorded and you can go back and listen until you are an expert. Then the rest of the week, we have webinars Tuesday, Wednesday, and Thursday with different providers within our network who can provide you with the properties that would fit, would meet this criteria for the Opportunity Zone Fund, and where most of it is done for you. So still kind of a turnkey model, but within the Opportunity Zone Fund. So that's exciting. All right, so Clint Coons, thank you so much for being with us here today and sharing your insights.
Absolutely, Kathy. I'm looking forward to it. I have to say, I spent a lot of time this weekend going through everything, getting it ready for this presentation. So I'm excited to give the information. I think a lot of people are going to learn some things because, as you stated, there's a lot of confusion out there. And even in my own research and studying the stuff myself and bouncing back and forth between different CPAs, 5 of them will say one thing and 5 of them will say just the opposite. And so we got some clarification last week. So that's really good going forwards. And as you stated, there's tremendous opportunity here if people know how to set it up the right way and they do everything they're supposed to.
And I do want to just let people know that your company offers that service, because you might be listening to all this going, I don't know what he is talking about. There's no way I could do this on my own. And the good news is you don't have to. Anderson Business Advisors can set up the fund for you, and then Real Wealth Network can refer you to property providers who can provide assets that meet the criteria. So with that, show us what you got, Clint.
All right. Well, I'm going to throw up that disclaimer slide for everyone here. Basically saying you can't rely on anything I say, and that if anything happens because you take action on it, you're on your own. Now, this is just a standard disclaimer here that we're going to put up, so we'll just skip past that. And we'll get in the material. Now, before we go through the presentation, I want everyone to understand I will be using certain designations throughout, just because, as you can see here, qualified opportunity zone, long word, and so I'm just going to refer to it typically as QOZ. So as I'm working through the slides and we're talking about the information, if you see QOZ, it's referring to the opportunity zone itself. That is the zone that's designated as a community opportunity zone in each state. And so I'll just use that designation. When we use the designation QOZF, that's a qualified opportunity fund or qualified opportunity zone fund. And this is a partnership corporation. It's an entity that is organized to invest in a QOZ. And if you see me use the initials QOZP, that's Qualified Opportunity Zone Property. So it's an interest in a qualified opportunity zone. Typically, because of this presentation, it's going to be real estate. So those are the three designations you'll see throughout the slides, and I thought it'd be important to put those right at the front. So when you're looking at that later on, we're on slide 29, and you see QOZ, you can always refer back later on to these designations. Okay, now, what is it about qualified opportunity zones? Why are people excited about them? Why should you be looking at investing in a qualified opportunity zone? Well, the tax planning idea or the thought process behind this was, let's have each state designate certain areas in their state that are economically depressed that people could then invest into to revitalize those communities and bring much needed funds into there. So each state was given the opportunity to designate certain areas within their state as a qualified opportunity zone area, and then they submitted them to the IRS, and then they were certified. So all of this came out of the Tax and Jobs Cut Act at the end of 2017, where these zones were created. And last year, there wasn't a lot of movement here. As I was listening to other professionals and reading publications, you saw some interest in this, but not a lot. It wasn't towards the end of 2018 that people started to wake up and they realized, hey, there's something that's going on here that we may be missing out on. I know Kathy had been talking about it. She was one of the first real estate investors that was out there that was promoting this and telling people that this is an opportunity and that you need to bone up on it. But some of the problems we had was that people didn't understand it because there was some confusion. What they did when they enacted the laws, they basically left it Treasury to come up with regulations to figure out how it's going to be interpreted. It's about as clear as mud, is what my partner and I always say, and we basically sit there and go through these regs with a bottle of aspirin, because about 25 pages into the 160 pages they just released, you start thinking, gosh, what am I doing to myself? But at the end of the day, you sit back and you go, there's a lot of benefit to be had here, and there's ways you can work this that I think if you're selling assets, it's something that you need to know. It needs to be in your repertoire because it can actually save you as well. And I'm gonna give you some examples because I've dealt with some people in the Real Wealth Network who have experienced this, where they've had gains and they wanted to defer them, not pay taxes on them. So we found a solution through opportunity zones. And so what is it from a tax incentives standpoint? Well, to encourage the investment, what they did, and then when I say they did, what the White House did in asking Congress to pass this in the law, is they basically gave you three main benefits, okay? The first benefit allows someone to defer capital gains as long as it's invested into a qualified opportunity zone fund. And when we're talking about gains, one of the gains we're referring to is gains from the sale of real estate, which is often referred to as 1231 gain. It can be either short or long term. So you don't have to hold it for a year and it'll still apply. This also includes that depreciation, which is considered to be 1250 gain. So if you're holding a piece of property and you've held it for 10 years and you've depreciated it for all those 10 years and you now sell it here in 2019, well, if your capital gains on the sale of that property is $100,000 and your depreciation recapture is $25,000. Well, if I did not roll that into this zone to defer that gain recognition, then I would pay tax at 20% on the $100,000, and then I would recapture that $25,000 in depreciation at a flat 25% tax rate. Well, under the regulations and under the qualified opportunity zone, if you roll that into there under 1400Z, then you can avoid taxation, or you can avoid taxation on the roll, and you'll defer out that recognition till some point in time, which we'll get to in a minute. So the type of a gain it applies to is capital gains from the sale of real estate, also from the sale of securities. So if you have stock, let's say you sold Apple stock, that would apply as well. That's 1221 gain. Now, sale of a business, if you had an existing business interest, you could sell that. One of the things that I'm bringing up here is 1256 straddle contracts. This happens to do with anybody who invests in the Forex. So we have a lot of clients that are Forex traders. If you're listening here and you invest in the stock market and you're into the Forex, and it's a 1256, that income can be rolled over unless it's part of a hedge or a straddle, then it's not qualified. If you don't know what I'm talking about, don't worry about it. You can just ignore anything I said. But if you're one of those traders who's listening in right now, watching this webinar, then you have to be careful if you're using that type of gain. Another benefit is the phantom income, gain generated from the sale or transfer of an appreciated asset. For example, let's assume that I had a piece of property and I transferred it out of a C corporation to myself. Or an S corporation might be a better example, then that is a taxable event. Even though I did not sell the asset, I still have to recognize that taxable gain. Well, that type of gain right there is also eligible to be rolled over into a qualified opportunity zone fund. So even if you don't receive cash, you can still take that taxable income that's attributed to you and roll it into the fund. So that means you have to come up with money from some other source, of course, but it would still qualify for a rollover into that. So this can be beneficial, especially even with syndications. Sometimes we have syndication interests that produce gains to the members, but they don't actually receive the cash right away. Those gains that they receive, even if they don't receive cash, those gains, if they have the other cash available, can be rolled over into a qualified opportunity zone fund. Now, the rule is that when you're rolling qualify or these gains over, they have to be reinvested into the fund within 180 days of the sale of a capital asset. Now, that is with all gains other than gains that I say are 1231 or come from the sale of real estate. From the sale of real estate, those gains have to be rolled over with 180 days at the end of the taxable year. So if you're trying to parse this out, don't worry, I'm going to show you some examples right now. So let's assume that you sell Amazon stock and this taxpayer realizes 200K in gain on April 15th, 2019. So how long does he have to roll the 200K in gain into a qualified opportunity zone fund to defer the tax on the gain? Well, what we would have to do is look at 180 days from April 15th. So that would give him until October 12th, 2019 to get those gains, the 200K placed into a fund if he wants to defer tax on the sale of that Amazon stock. Now let's assume that rather than selling stock, this taxpayer sold a house and generated $200,000 in gain. Now, how would our answer change? Well, in this situation, since this is what I referred to earlier as 1231 gain, sale of real estate, in this case, we have 180 days from the end of the taxpayer's taxable year, which would be December 31st, 2019. So here you can stretch it out all the way until June 28 of 2020. So you've got two different types of gain you have to look at here. If it's gains come from the sale of real estate, then the 180-day clock begins to run at the end of your taxable year. Now, when does a qualified opportunity zone fund have to invest into an opportunity zone? Well, here's the deal. Then once the funds are put into your qualified opportunity zone fund, then you have another 180 days. So if you look at example number 2, where the individual sold the house, you can effectively delay the investment of that $200,000 for a year and 9 months or 8 months. You could avoid it for a year and 8 months before that actually has to be used to buy property. But you just have to put it through the process in the right order to make sure you're hitting these target dates. Now, what if instead of selling a house, the taxpayer holds an interest in a syndication that sells a building for gain on February 3rd, 2019, and the taxpayer has 100K of that allocated to him? So when would that clock begin to run? Because in this case, you don't own the property. You're invested in the syndication that sold the property. You have not yet received any distribution of cash, but you know that you have $100,000 gain in there, or maybe you did receive the $100,000 in distribution of cash. It doesn't matter. The question is, when does that clock begin to run? Well, just like the sale of the real estate, the clock begins to run at the end of the taxable year. So in this particular case, since the syndication was a partnership, its taxable year is December 31st. That's when the gain is actually realized by the members in the syndication. So you have 180 days from December 31st to invest that money into a qualified opportunity zone fund. So a lot of the reason I'm going kind of deep onto this is there's a lot of confusion with people as to when they need to roll their gain over, that there's more time than you may realize when it comes to selling an asset to get that gain reinvested in order for it to qualify for the other benefits we're going to be talking about. So again, when does the fund have to invest it? In this case, 180 days from the first month of its inception. So using the preceding example, it'd be December 26th of 2020 if I was in that example I just showed you. So that's the first benefit, that if you sell an asset and you have capital gains, you will not have to pay tax on that in the year of sale if you roll those funds into a qualified opportunity zone fund within the requisite period of time. So that's one great benefit. Now, second benefit here, any capital gains that's invested, okay, the tax on that, okay, is going to be deferred until 2026. Now, understand that you're going to be able to avoid the gains, but it's a deferral mechanism here. So come December 31st of 2026, as long as you have your assets invested in a fund and you've not sold it and cashed out or cashed out of the assets, then at that point in time, you will have to pay tax on the amount that you deferred. So you are getting a deferral period here. It's not the elimination of the gains that you incurred this year or next year. It's a deferral until 2026. That's when you will have to pay taxes on that. And so that's what they're going to do then, is they're going to figure out how much of that was capital gains taxes, using the example of the sale of real estate. So that's going to be taxed at 20%. And how much of that was deferred depreciation taxes you needed to pay. So 25% on that 25K would come up there. Now, keep in mind, I use the 20% long-term capital gains rate and 25% on the 1250 gain, but the gain is going to be subject to the tax rates that are in effect in 2026. So we don't know what those rates are actually going to be yet. There may be a change in 2020 and somebody else comes into the White House and takes over the Senate, and they may say, all right, we're going to eliminate capital gains and make it all ordinary income. Who knows? So the tax rates aren't the same that we have today. They're going to be whatever taxes are in 2026. I don't think that's a deterrent to me to defer the gain, but it's just something you should be aware of. All right, second benefit. You get a basis in the increase of the qualified opportunity zone fund if you hold that asset in there for at least 5 years. So what that means is that if you invest into the fund and it's held in the fund for 5 years, the basis will be stepped up by 10%. And if you hold it for an additional 2 years, then your basis will be increased by another 5%. So if we had $100,000, let's say in my example, that I rolled into a fund, then my tax basis in that $100,000, when I have to recognize it in 2026, will be increased by $15,000 because I got the first year 10% step up, and then our first 5 years gave me a 10% step up, and then in additional 2 years I got another 5%. So instead of paying taxes 20% on 100 grand, I will pay 20% on $85,000. But again, you have to meet these requisite holding periods. Now, I put this note on the bottom of the slide. You see, in order to meet these two, the 5 and the 7 year period, if you want to capture both of them, you have to make your investment in 2019. Because after 2019, you will not be able to meet the 7 year holding period. So if you invested next year into a qualified opportunity zone fund, then your basis increase will only be the 10%. And the reason I say that is because you won't be able to hold it for 7 years prior to the 2026 deadline coming and whacking you at that point in time and saying, all right, you have to pay tax now on that deferred gain. So there's a bit of incentive here to front load, I think, this code provision, that they wanted to spur economic growth and they wanted to get people, investing in these communities. So they gave you some incentive to say, listen, you best get on it, start selling some assets and rolling those gains over, because we're going to take these benefits away over a period of time if you don't make it roll it in by 2026. So you can see here, if I made my investment in 2023, I wouldn't get any step up in the basis, and I would have it in the fund for 3 years, and then come 2026, I'd have to pay tax on the full $100,000. So this deferral is declining over time for those monies. Okay, the third benefit, and this is the one that gets people, I think, even more excited, is the fact that when you make this investment into a qualified opportunity zone fund, if it's held for at least 10 years, then the basis in the investment is the fair market value on the date of sale or exchange if sold between 2028 and 2047. So what does that mean? It means this. You have until 2047 to peg your basis. So you choose at that time, either sell it or you say, I'm going to recognize the gain right now and step my basis up. After 2047, you no longer have that opportunity. So 2047 is kind of it is the end date here for these zones to capture all of that basis or all of that increase in the property's value and not pay gains on it. So if I had purchased property in 2019 and I held it until 2030 and the property increased in value by $500,000 over that holding period, if I sold it in 2030, I will not recognize any of that gain as taxable income. It's completely tax-free to me. If I don't sell it, then I just need to make an election in that year if I wanted to, and I'm not sure why anybody would do this, but they put it in the regs. I'd have to elect to treat it recognition at that point in time. So they're not going to force you to sell it. And I think really the reason why they put that in there is because of that 2047 deadline. They don't want to force somebody to sell. They're just going to tell you that by that time you have to recognize it. So any gain beyond 2047, you will pay tax on it at that point. Now, this is really important because there's been, I think, a lot of confusion out there as to what is eligible to be rolled over. I mean, if I sold a piece of property for $500,000 and $200,000 of that was gain, and I decided to roll the entire $500,000 in, how much of that is tax, or how much of that will I benefit from this gain deferral? Well, the statute only refers to gain that is invested, not cash. So if you invest cash into a qualified opportunity zone fund, it's not eligible for any of these benefits that we've just been talking about. So if you put in $100,000 today of cash you had in your savings account, in addition to $100,000 in gains, so you made a $200,000 investment into a qualified opportunity zone fund, the $100,000 representing the cash from your savings would not be eligible. So if you sold some asset later on, 50% of that is going to be taxed to you. 50% would not, because you had the gain that was rolled in. Now, there's a workaround for this, and I have it. It'll be towards the end of the presentation. In example number 6, I'll show you how you can get around this. I mean, it's so obvious how you can do it that I'm surprised more people haven't been talking about this, and rather than just saying you can't roll cash in to it. So anyways, we'll move on. All right, so let me give you another example of how this plays out then, so you understand these gain deferrals. So if you had, you've invested $2 million in 2014 into Apple shares, you sold the stock in 2019 for $3 million, resulting in $1 million of capital gain. You invest $1 million of that gain into a qualified opportunity zone fund, and the $2 million does not, of course, have to be reinvested. So all we have to do is invest the gain into the fund. So what do we get there? Well, in 2019, by making that investment, I will defer paying tax on $200,000. That represents 20% of that $1 million in capital gain. In 2024, since I've held it for 5 years, I will then be able to step up my basis in that investment by 10%. So when you put the money in, since it's all gain, you never pay tax on it, you have zero tax basis. So remember, when you're looking at how much gain you have on the sale of an asset, you take what you sold it for less your tax basis, and the difference is your gain. Well, now in 2024, I get a step up of 20K. So now my tax basis in this 200,000 is $20,000. So if I sold the asset today, then I would only pay tax on $180,000. So I save $4,000 in this example by doing that. And then in 2026, you're going to get another 5% if you're still holding that asset. So now it's stepped up another $10,000. So now my tax basis is $30,000. So by holding it for 7 years, I save $6,000 in taxes. But come the end of 12/31/26, you will have to pay tax on that entire amount. So this is how it works from a tax perspective. When you defer that gain, you hold it for the requisite period of time. Now, the tax benefits for the Opportunity Zone investment itself. Well, what you're going to have here is you'll see that your basis is increasing in the fund. So I started with a $20,000 basis in 2024, then it went up to another $10,000, so it's a $30,000 tax basis. Then what happens when I have to pay tax on all of my deferred gain, the 200, my basis in my fund is now increased to $200,000. And the reason you need to track this is so that if the fund liquidates prior to the 10-year mark and the assets are sold, or you dissolve, or you do something like that, then you're going to need to know what your tax basis is in that, so you don't pay tax on all of the gain that is attributed to you. But if you hold it until 2028, the 10-year period, then your outside basis will increase to the fair market value. So that's how it works from inside of the Qualified Opportunity Zone Fund. So with a lot of times people are bringing up 1031 exchanges, and so I thought I'd spend just a few moments here to compare it to a 1031 exchange, so you realize there are some significant differences between these two. The thing about a Qualified Opportunity Zone is that you do not have to invest the entire amount of your capital gain. And you can choose any portion of that. Whereas in the 1031, you have to invest not only all your gain, all your basis, and the debt needs to roll in. So you got equity, debt, and gain needs to be rolled into a 1031 exchange to avoid taxation. With a Qualified Opportunity Zone investment, your cash is fungible, so you don't need a qualified intermediary. It means you can touch the money. With a 1031 exchange, you can't touch the money. It has to be held by a QI, qualified intermediary, because if you touch any of the funds, then it's taxable to you. And the thing about a Qualified Opportunity Zone, I think what makes it better than a 1031 exchange is the gain can come from stocks. It can come from any type of capital asset. Whereas with the 1031 exchanges, you're really only limited to real estate now. And the gain can be short-term, long-term, whereas 1031s can only be long-term. So if you were a stock trader, or you're a house flipper, or you flipped a house, you can't be just a house flipper. If you're flipping houses, then that would be dealer property, so that wouldn't be eligible. If you were in that situation, we would have to do some strategic planning there to try to take some of those assets and move them off to the side. If you knew you had a big flip going on, I'd definitely tell you to call us, and we would isolate that asset to treat it as short-term capital gains, so you could roll those funds if you wanted to into a Qualified Opportunity Zone. But nevertheless, you can roll short-term, long-term gains in, whereas with 1031, it's only going to be long-term. With the like-kind exchange of a 1031, only real estate investments can be used now for 1031 exchanges. However, all other assets that you used to be able to do are no longer available under Section 1031. So this was a change in the code that came down in 2017. Maybe you've heard of it before, where people would take real estate and turn it into planes or something like that that are held for investment. You can't do that anymore. It's got to be truly like kind. And then replacement property can be any real property, of course, located anywhere in the U.S. for 1031, but with a Qualified Opportunity Zone, you're only limited to those areas that have been designated. So that's one drawback on the QOZ side, is that you can't invest outside of those zones. And as I stated earlier, you got to roll all the money into replacement property with a 1031. So if you download the slides, I threw this in just as a summary of the differences between the two. I think it's beneficial to have if you're trying to determine which way you want to go. You can just refer back to this slide right here, and it breaks everything down for you. Now, a lot of this focuses on the federal law. What about state law implications? That's kind of up in the air right now as far as how state law will treat the gain you recognize from a sale. And unless the state conforms to federal law, then you may not have income deferral on the sale of a capital assets. Now, a lot of states will piggyback off the federal law, but some of them can decouple, which means they want to go their own way. Hawaii, New York didn't decouple, but Hawaii did, just to give you new examples. So you need to be aware of what your state will do with that gain. So just because the feds are not going to tax it and they're going to allow you to defer it, doesn't mean that the state in which you live, or even where the property is located that you sell is more important. The capital asset will allow you that same deferral. So here's a little map of the various states that show you which ones currently have conformity in effect. Which ones have selectively conformed, meaning which aspects they want to take into account for this law, and which ones they will not recognize, and then those where there aren't any conformity yet, because maybe they don't even you don't have to consider it because they don't have a tax rate. So this is a little general map for you that you can refer to later on if you're wondering about your state law and what its implications might be on the sale of an asset. All right, so
can you go back
what's that?
Real quick, that one, and when you say, so let's say the light blue or the green, let's say green because there's California, does that mean that you would pay the state tax as well?
It means that there may be some tax, there will be some tax associated with the sale. So they have selective conformity on the assets. It may not be the entire amount, it may be something less, but these are the states that do not fully conform to federal law.
Okay, and then the sort of baby blue, what is that?
Those are specific state where they conform to federal law.
So you would not pay extra state, yeah, because correct. Texas, Florida, you don't pay anyway. Okay. Okay, thanks.
All right. Now, qualified opportunity zone fund. Now, this is how your investment is going to be made. So I'm going to now talk about what is a qualified opportunity zone fund. So a qualified opportunity zone fund is a partnership or corporation, and you elect to be treated as a qualified opportunity zone fund on a specified month in 2018 or later. So it began last year where you could make the election. Now, in order to do that, 90% of the fund's assets need to be invested in eligible property or eligible partnership interests or stock. And the thing about this is there's 2 semi-annual testing dates that you have to look at to ensure that your qualified opportunity zone fund conforms to this requirement. So the 90% means this, that at the end of your first 6 months of the fund's taxable, at the end of the first 6 months of the fund's existence, you have to do a test to make sure that 90% of the assets are actually invested in a qualified opportunity zone. And then it has to be retested at the end of the year as well. So there's 2 testing dates here. And then on an annual basis going forwards, each and every year, your fund will need to be tested to ensure that it's holding 90% of its assets in a qualified opportunity zone. So when we talk about investments, the investments must be in equity for income tax purposes. So if you're investing into a fund, you can have your fund set up where you're getting preferred equity, you can have special allocations. They don't care how you set it up as far as your investment is concerned, but as long as you're putting your money into the qualified opportunity zone fund, and that's, as I stated, a partnership or a corporation, and an LLC can be a partnership, as long as you're making that investment, then it's up to the fund to ensure that it complies with federal law to make sure that it will be a qualified opportunity zone fund. So as long as it's complying, then you're complying as well. Now, typically when we're looking at these, we think of creating new entities And that's what I would always recommend, is that when you're going to make an investment, you set up a new entity, that a new fund be created. But existing entities can elect to be treated as a fund. So if you had an existing LLC, for instance, that you had floating around and you wanted to turn it into a fund, and that was, say my LLC was set up in Texas, you could do it. You would just have to specify the month in which it's going to become a fund. So you have to pick a day of a certain month and say, all right, from this day on, this is going to be a qualified opportunity zone fund. And the reason why you need to do that is because once you identify the month, then you have that 180 days that starts ticking in which you have to get invested. But the problem with this as well is that if you're going to do that, you have to make sure that, assets that this current LLC holds is going to be, meet that 90% test, and that you do not have ineligible investments held in there. So if I had an existing LLC, and I had somebody talk to me about this not too long ago, it was Texas, they had a couple rental properties and they're looking to buy a third property in an opportunity zone, and they wanted to use their existing LLC. And I just said, you can't do it, because you're not going to meet the test, because 90% of the LLC's assets will not be in an OZ area, because you already hold these two properties. So you have two choices. If you want to use the existing LLC, dump the existing properties out of there and put them in a separate LLC, which would be kind of stupid because you'd have to file a bunch of deeds. Instead, let's just set up a new limited liability company that qualifies as a qualified opportunity zone fund and make the investment through that entity. So pre-existing entities, it's something that I would not do, because it's gonna be a disadvantage to you to meeting that 90% requirement if they have existing assets already held inside of them. Now, when we're talking about these assets, what am I referring to? So here's what you're looking at. Okay, you can have your fund can hold newly issued stock of a corporation that invests in a qualified opportunity zone, that is itself a fund. So this is where you have to wrap your head around it and grab out the bottle of aspirin. So you can create an LLC that's a qualified opportunity zone fund, and you don't need to go out and buy the property itself. You can turn around and invest in another qualified opportunity zone fund that's making the investment. So this can be either through a partnership, another LLC, a syndication, or it could be through a corporation. But a lot of the people we work with are going to go out there and actually buy the property themselves. And so the way they always refer to this is that you invest in a tangible business property in a qualified opportunity zone. And some people get thrown off by that word, tangible business property, but real estate's going to meet this test and fall within that definition. So as I stated, if you're investing through your own fund into another fund, then those entities have to meet that 90% test. And if you're investing into a fund that isn't buying real estate, that's actually running a business in there, then they don't even have to meet the 90% test. Really, they only have to meet a 70% test. And this is where it starts to get really complicated with these things. And I purposely left out a lot of the slides that I would have used if we were discussing actual businesses that you wanted to create in there. So I'm just going to continue just to focus on real estate. But I want to let you know that through these investments, truly, if you set up your own fund, only 63% thereabouts of the assets need to go into a qualified opportunity zone through layered funds that you create. All right, so let's talk about property. Okay, so tangible property is equipment, real estate used in a business in a qualified opportunity zone that is acquired after December 31st, 2017 from an unrelated party. So that means you can't go out and buy property from your father or your son and hope for this to work for you. Those are unrelated, those are related parties, and it will not pass the test. Similarly, you couldn't take an asset you hold in your corporation or LLC and sell it to yourself and think that you're going to benefit from here. It will not pass the test either. So what are some of the assets that we can acquire inside of a qualified opportunity zone fund and get this benefit? One is land. You could do that. a building in a qualified opportunity zone fund that is first used by the fund or for a new business. So this would be considered new use. So you could, build something in there. You could acquire a building that was previously used, and then you have to substantially improve it. I'll talk about that in a little bit. And that would then qualify. So I can have land, build something on it, make it new use, qualify. I can buy an existing building, and it would qualify. Equipment would qualify as well. Equipment that was previously used in an opportunity zone fund, but it's substantially improved, would qualify as well, and that would be considered to be existing use. And so I have some examples of that we're going to get into. Cash. So we're talking about buying assets here, real estate and things like that, but what about cash? Well, does cash qualify? And so this is something you have to pay particular attention to if you're going to set up your own fund and you're putting money in. Now, when you invest into your own qualified opportunity zone fund, you can store cash if it's going to be used to substantially improve some property, and I'll discuss that in a moment. But what you cannot do, if it's not going to be working capital, then you just can't sit on money inside of one of these funds. The money either has to be distributed out, the income. So, when we're talking about qualified opportunity zones, I want you to understand that the deferral is on the appreciation of the asset. If the asset itself is turning over 30 grand a year in taxable income, you're going to pay tax on that income as it comes out to you. So that's not going to change the nature of the investment. But if you decided to hold that cash inside of the LLC and you don't distribute it out to yourself, that could be a problem, because it's limited to 5% of the average unadjusted basis of the property held in the trade or business. And you have certain problems. You can't hold non-qualified financial property. I mean, your qualified opportunity zone fund couldn't hold short-term debt. So let's say you sold a piece of property, you're carrying back an installment note. You couldn't do that. You couldn't hold stock in Apple inside of there. I gave you some examples here. It has to be invested in qualified opportunity zone property. The only thing you're allowed to hold cash-wise is working capital, okay? And that will not be treated as this non-qualified financial property. And this is how you're going to make a lot of your investments. This is what the people I've been working with have been doing with their qualified opportunity zone funds, is because the nature of the fund itself requires, or the way the law is written, that you make substantial improvements to property. So you have to have working capital. So an example would be, if I'm going to buy a property in Texas, then I'm going to want to go in and make sure that I have ample cash available to rehab that property, because as we're going to discuss, you have to substantially improve that property within a certain period of time in order for that property to qualify. So in so doing, you're going to be holding on to cash inside of your qualified opportunity zone fund that is going to be earmarked for that improvement. And if you're going to do that, you have to have a written plan in place. So if your plan gets tested by the service, let's say they see that you have a house in Texas, in Houston, the house is valued at $55,000 and you're sitting on $70,000 in cash. Well, what the service might say to you is, listen, you're supposed to have 90% of your fund invested in opportunities in an opportunity zone or qualified assets. The cash isn't qualified, all right? Only the property is. And because you have $70,000 in cash and only $55,000 in opportunity zone property, you fail the 90% test. However, if you tell them, well, that cash that I'm holding in there is working capital and it's going to be expended for this actual property itself, then it'll allow you, then the service will allow you to hold that cash, provided you will be using it within 31 months to improve that $55,000 property that you hold inside of there. So you have to have a written plan set up describing that. So this then comes down to, when you're looking at making your investment, you have to understand there's a difference between new use and existing use property. So new use is new use of real estate in a qualified opportunity zone that begins with the acquisition by the qualified opportunity zone fund. So new uses, you're going to come in, and I have some examples we'll go through on this, that you're going to come in and you're going to create new use out of something. Existing use is an investment that will continue the use in the same manner that it was prior to your acquisition, such as rental real estate. And so if it's existing use property, then you have to substantially improve it over 30 months. Now, the whole purpose of this, putting in this new use versus existing use, is that when they drafted this provision, they realized that they didn't want to create a law that just incentivized real estate investors to come in and buy up a bunch of real estate in these opportunity zones and not put any money other than the acquisition price into there. So if you're coming into a community that's an designated as an opportunity zone fund, and you're going to turn that property into a rental, it's already a rental, that is, you just want to continue that, they want to see some investment in that community, that you're committed to it. And so the rule that they promulgated is that, yeah, you can invest there, and yes, it's not going to be a new business you're creating, it's an existing business, but you have to substantially improve it. So you have to put some skin in the game. And so the rule is that to substantially improve the property, that Texas property, for example, that was 55 grand, well, you have to improve it by the value of the property, 100%. So in that case, I'd have to invest at least another $40,000 into it. And the reason I say 40, because you can exclude the land itself for your calculation in order for that asset to qualify. Let me give you an example of that. So a taxpayer has $500K in gain from the sale of a house that he invests in a qualified opportunity zone fund to purchase a duplex in the qualified opportunity zone for $275K. So the question you first ask yourself, is this new use or existing use property? Well, the duplex, since you're buying it with the intent to rent it out, this is existing use property. You're going to take it and you're going to continue to rent that duplex. So you're going to be generating income off of it. So now, since it's existing use property, not new use property, then we have to substantially improve it. So the fund will have 30 months to improve the property by 100%. That it means it'll need to double the value of the duplex, but you exclude the land, of course. So when you're structuring your purchase, let's say you're going into Texas, and you're going to buy these turnkey houses. It used to be you would just come in and buy the turnkey house already rehabbed. That strategy does not work in an opportunity zone, because if it's already rehabbed, you're not going to be able to invest any more money into it. So you have to buy the properties pre-rehab. You have to fund the rehab yourself out of your fund in order to get this substantial use. So when you're buying the property, let's say, it was this 55K house, what I would want to know from the seller who's selling me this turnkey property I'm going to pay to do the rehab work, it's all right, how much of that constitutes land? All right, so if they told me that 10,000 of it is the land, then I want to know, what is my rehab budget to get this property fully stabilized so I can start renting it out? If they tell you that your budget for that property is going to be 30 grand, well, in my example, if we had a $55,000 purchase of which 10K is allocated to land, that leaves us with $45,000 allocated to the property itself, the building, the structure. So if I have a 30K rehab budget, I am not doubling the value there. So I'm going to be short by $15,000. So what do? Well, you can opt for granite throughout the house. That would be one thing to do. Harden the house the best you can, which is, it's not a bad idea if you harden your property, because then you're going to have less CapEx on there. Or what you could do is maybe negotiate with the seller. Say, all right, well, couldn't this land be worth a little more? If we can allocate more towards the land than the value of the structure, then I can fall within that $30,000 possibly, or we can come closer to that. And so that's something you have to work out with the actual seller. But you have to make sure that when you're buying the property, you're buying it pre-rehab if you're buying single family, because if you're buying it post-rehab, then you're never going to be able to meet this test. And then, of course, any funds you roll in have to be earmarked for that improvement. Now, here's another example. A qualified opportunity zone fund buys an existing commercial building for $10 million on March 1st. Assume that $2 million is attributable to the land and $8 million is attributable to the structure. So is this new use or existing use property? Well, of course, this is going to be existing use property. So in this case, since it's a building, what we're going to need to do, if we're going to construct, if we just bought the land and we're going to construct a new building, of course, it'd be new use. But since we bought it and already had a building there, it's going to be existing use. So we have to substantially improve that building. But you'll see in my example, I said $10 million, but $8 million is attributed to the structure. So you wouldn't need to invest $10 million into their improvement. You would only need to invest $8 million into the improvement of that structure because you're able to exclude the land, and you have to do it over that 30-month holding period in order for it to qualify. So a couple other things here that I'd mention on that I can't recall if I put them in here or not, that we're just thinking about this when you're investing. When you're investing through a qualified opportunity zone fund, you can still sell these assets and you can then reinvest them. So let's say I did this deal right here. I bought that land, I got the building, multifamily, I get it stabilized, and 6 years from now, it's stabilized. I'm looking at interest rates. I'm concerned that interest rates are going to start going up, which is going to, of course, increase cap, but drive down my sale price. So what I will then do is put it on the market and I sell it. Now, I haven't held it for the full 10 years, have I? Because I'm selling it in year 6 after it's been stabilized. Well, don't fret. You're not going to have to pay taxes on that money if you sell this, and this is, you have your own qualified opportunity zone fund set up. You set up an LLC. We created one for you the right way. You sell that asset. As long as you turn around and reinvest those proceeds in another qualified opportunity zone within 1 year, you're good. You don't even need to put them into a property. You can go and invest into an existing qualified opportunity zone fund that's out there and you'll be fine. So you can actually then keep your holding period going, and then you get the 6 years that you originally held it, and then you hold it for another 4, now you hit the 10. And so you have that ability to swap assets held inside of a qualified opportunity zone fund, sell them, reinvest in another OZ area, and you won't have tax recognition on those investments that are sold as long as they're reinvested in 1 year. So that's nice. That was some clarification that we were looking for that just came down in the new regs. So how do you create your own qualified opportunity zone fund? Well, first off, you want to create an LLC in the state where the property is located to be taxed either as a partnership or a corporation. So that is a requirement that we have there. And then after you've set up the LLC in that state, you'd then want to draft an operating agreement that contains qualified opportunity zone fund provisions that are going to allow you to meet the certification requirements. So one of the things when this law came about, my partner Toby and I sat down and we custom drafted an LLC, and we've modified it too since the regs have come out, that specifically meets everything the IRS requires that you're going to want to have in that operating agreement, to put in there the language to meet the limitation on the investments, that it can only, 90% investment test or 70% in certain situations. So you would need that language in there. So if you were audited, you could show that here's my fund and it has all the requisite language. So that's key. And then you need to elect the first month the LLC plans to be treated as a qualified opportunity zone fund, because that's going to start the 180-day clock running. Well, when you make your investment, so if you're going to invest into a qualified opportunity zone fund, your own LLC that you create, the day that you make your investment into that fund, you should have elected to treat that as a QOZF 1 day before that. So it needs to be a fund prior to you putting the money in. So you don't make this mistake. Set up your LLC, don't elect to treat it as a qualified opportunity zone fund, and open a bank account, roll your money in. 3 months later, you turn it into a fund. you just blew the whole deal for yourself. So these rules, the timing of the investments you're making into them, you have to pay particular attention to that, because you could screw it up really quickly if you don't know how these things need to come together. And then once the gain is contributed, as I stated, to your qualified opportunity zone fund, the LLC, which is the fund, has 180 days to invest the gain into a qualified opportunity zone. Remember, the cash must be earmarked for improvement. So again, if you're buying turnkey properties in Florida, Kathy brings in a lot of different groups for this, then you want to make sure that you are negotiating with them with the understanding that if I'm buying in this area, that I'm buying it pre-rehab, and then I'm going to fund the rehab work with the cash that's held inside of the fund as we go forwards. And then you'll need to perform an audit at the 6-month mark to ensure compliance. But if you create your fund in July, August of this year, you won't meet the 6-month mark. You can skip that. You'll just perform your audit at the end of your taxable year. But if it's created anytime before July, then it's going to have to be evaluated 2 different times. So the first year that you set this up, the first 6 months into it, as long as it's before the end of your tax year, you do have to do an audit of the fund to make sure it's in compliance. Now, the thing about these is that it's self-certification, okay? But in order to self-certify, you don't want to miss the filing of 8996 when the tax return is filed for the Qualified Opportunity Zone Fund. This is critical. These are certain things that cannot be missed. And then you must also file, you as an individual, if you're investing in this, you got to file 8949 with your 1040. I was talking to Kathy earlier, and she brought up a situation. She said, what happens if I sold a piece of property last year, and I just filed my tax return on April 15th. I recognize $175,000 in gain on the sale of this property, and now I want to invest into a fund. Am I screwed? No, you're not, because what you can do is you can amend your 1040 for 2018, file it with 8949 to treat that gain as being rolled into Qualified Opportunity Zone Fund, and then get that gain rolled in to an LLC that you set up within the 180-day period, before June, what was it, June 26 or something of this year. So as long as you do that, you're golden. And so if you're thinking about it, anything you did last year, if you sold stock towards the end of the year and recognized capital gains, if you sold real estate at any time during the year and you would like to avoid paying tax on that, and maybe you've already did, your CPA didn't tell you this, give us a call. We will then amend your tax return, file the 8949, and get that money back from the IRS, and then you invest it in your own fund. And then you have to perform that annual asset compliance test to make sure that your plan meets the 90% investment in the OZ areas going forwards. What about some other issues? All right, so here's some of this stuff. These other issues were recently clarified in the most recent reg drop. Land. So one of the questions that came up, or concerns that people had, is what about if I buy land and it has a dilapidated building on it? And the building's maybe, and you look at it's worth $40,000. Is this new use or existing use property? Well, even if it wasn't worth 40, maybe it was worth $400,000. The question comes down to this: if that building, that structure on the property, has been vacant for more than 5 years, then the structure is ignored and the land is considered to be new use. And the reason I bring this up is because if you have new use, then you don't have to worry about that substantial improvement issue. Remember, you have to double the value. You just got to build something on there and put the property to use. So that was an area, because in some of these opportunity zones where people are investing, there's structures on there that are tear downs, and you're not going to substantially improve it. You're just going to demolish it, and you want to start over. So we needed clarification on whether or not that would what would qualify in order to make it new use, so I don't have to double the value of a structure that's just garbage to begin with. Something that was interesting is that if you invest in a qualified opportunity zone, then you can pledge your interest as collateral for a loan, and it won't be considered a disguised sale of that interest. So, I work with investors who will hold interest in LLCs, and they'll go to apply for a loan, and they'll offer their interest in the LLC as collateral for a loan. You can do that with an interest you hold in a qualified opportunity zone fund, and it won't be taxable to you. You can also use you can sell your interest in your qualified opportunity zone fund, and as long as you roll it over to a new qualified opportunity zone fund within 180 days, then you'll defer taxes on it. So let's say you didn't invest in a fund, let's say you went into a syndication and you put in $300,000 of gain, and you decide, you know what, I'm not comfortable where the syndication is going, I want out. If you sold your interest to someone else and they paid you the 300 grand for your investment, as long as you take that 300,000 of capital gain that you made and you put it into another fund within 180 days, then your holding period keeps running and you won't have to pay tax on those funds until 2026. So you're allowed to do that. You can sell your interest and then reinvest it. Debt to acquire an asset. If you invest in a qualified opportunity zone fund or your fund, you can use debt to go out and buy property in a qualified opportunity zone. So you don't need to fund all these investments with cash. If you want, you can use debt. Now, this is the workaround to that cash issue I was talking about earlier. Remember, I brought up the fact that if you have cash, let's say you sold a piece of property and you have cash and gain, and if you roll both into your fund, you're only going to benefit from the gain rolled in as far as the 10-year holding period for capital gains deferral. The cash wouldn't qualify. Well, this is what I would do, all right? This taxpayer sells property in March 1st, 2019 for $700K, of which $400K is basis and $300K is gain. Taxpayer rolls entire amount in a qualified opportunity zone fund to purchase and improve real estate that is going to be rented out. On July 10th, 2030, taxpayer sells the asset for $1.2 million. How much of this gain would be tax-free? Well, you notice in this example, the taxpayer rolled $700K into the QOZF, and that comprised of $400K basis and $300K gain. Well, if he holds the asset for 10 years and he sells it for $1.2 million, then 43%, representing the portion of the eligible capital gain rolled into the fund, is going to be tax-free. The other 57% will be taxable to him. So when he sold it for $1.2 million, his basis is $500,000 or $700,000. So of the $500,000 gain, 57% of that is taxable because he used cash. So what do we do instead? To make the entire amount tax-free, what I would have done is structured this for this investor is we would have put in the $300,000 gain and then loan $400,000 to the fund because you're allowed to use debt. So by using the debt, I eliminate the cash contribution to acquire the asset. And now the total investment I've placed into this fund is strictly capital gains. I put no cash in. The $400,000 that I used to substantially improve the property came via loan to myself. So you have to put together a loan agreement, pay yourself back under the terms of that. But again, it's your money anyways. That $400K was just a return of basis, so it wasn't taxable to you. This is the way to put those deals together. And the service hasn't made any comments on it yet. And given the fact that you're allowed to borrow to invest, I don't think they will comment on this strategy as well, because it's just not going to hit their radar screen, but it clearly falls within the regulations, and it's something that's how I would structure it if I was putting a deal together. Now, multiple investments in a qualified opportunity zone fund, you can have multiple overlapping sequential applications of the 30-month working capital. So if you put money in 2019 to buy an asset, then you go in 2022 to buy an asset, in 2025, and as you're selling assets on the outside, you could do that. And the cash issue that I brought up earlier, you can have sequential tranches of cash going in, as long as that new cash that comes in is earmarked for the substantial improvement or the new building or new improvement of new property. As long as you earmark it, it won't blow the 90% rule. Now, even though this has been clarified, it's not how I would recommend you invest with these. I would make these single asset entities, because I think your accounting could get off, and if your accounting's off and you get sideways with the numbers and you get audited, it could be a mess for you. And again, think of who's auditing you. Are they always the sharpest pencil in the room when they're coming there? Not always. And so I would like to keep things, keep it simple and stupid as possible. And that's why I would do a single asset entity whenever I'm investing into these. Triple net leases. This is clarified now. Goes without saying, if you enter into a qualified opportunity zone, you set one up, you buy a commercial real estate building that's in an opportunity zone, and you enter into a triple net lease, does not qualify. They do not consider that to be a business because you are not participating in it with a triple net lease. Now, on a rental property, they're not triple net, so they classify that as an actual business, but triple net leases do not qualify. So you have to stay away from the triple nets. Death of someone, so let's say you invested in there and you pass away. Prior to the new round of regs that hit, the assumption was that you would lose any basis and everything would be taxable to you at that point in time. That has since been clarified. That is not the case. Your heirs can take over from where you left off in holding that interest. So if you set up an LLC to buy property and you're in an opportunity zone, they could then hold that, and they would get whatever holding period you had in that investment. Property straddling. So this was a concern. Let's assume that you're looking at a piece of property, but it's right on the line. All right, so you're buying this house that comes with 2 acres, and a portion of that is outside of the opportunity zone. So does that disqualify that investment? It does not. So if you see an asset that straddles the line, as long as the majority, of the asset as compared to the overall amount of the real property is based inside of the opportunity zone, the qualified opportunity zone, then it's deemed to be a qualified opportunity zone asset. So you're just going to look at it on a square footage basis. If 50% or more than 50% is inside the zone, then you're gonna meet the test. Sale of qualified opportunity zone asset. Yeah, I talked about this earlier. If you sell it, an asset in one of the zones, you have 1 year to reinvest the money into another qualified opportunity zone, and it will not be taxed. All right, so if you before I go into the questions on this topic, and we've covered a lot here, and if you want to discuss setting up your own fund, qualified opportunity zone fund, and I walked you through everything that needs to be done in order to do that. We set those up at Anderson. I made it really easy for you. If you want to set up a strategy session with us to discuss creating your very own fund this year, to do so, just go to this link right here, andersonadvisors.com to /get OZ fund. Okay, simple as that. AndersonAdvisors.com /get OZ fund, and on that page there'll be a little box where you can enter in your information. And once you enter that information in, then we will contact you. I'm going to post a link back to this webinar as well. If you want to rewatch it, that'll be up there here within the next day or so, because I just created this page. But these are opportunities that you don't want to miss. I mean, as I stated, the time clock is running. If you want to get the full 15% step up in your basis, you got to make the investments this year. You're going to lose out on that additional 5. And then the longer you wait, you could even miss the 10, because 2026 is our deadline, which requires you to recognize all that deferred gain. Okay, with that, if you have any questions, we can start answering.
We've got some questions. I know on the there was the first use and then the existing. We have a lot of property providers who have the new homes. Anything we need to know about that if the first use is in a qualified opportunity zone fund?
Yeah, so with the existing properties, since you didn't buy the land, that would not qualify in my reading of the regs and the statute, because you're coming into there. It's a property. It's an investment property, and so nothing has changed with that. That's why with those types of deals, it's best to have it structured where you're paying for any rehab work themselves.
Or you're buying the land and then paying the builder to build it. And okay,
correct.
But if it was just built, it's brand new, it's never had any use at all, and the first use is opportunity. I see that I wasn't clear on that.
Yeah, it would be no different than if you went into an opportunity zone and you bought a house from somebody who lived in it. Mm-hmm. Okay, it's residential real estate is what it is, and it's still going to be used as residential real estate. So the existing use is there.
Okay. Okay. Someone asked, I know you answered this, but we can answer it again. Can the gain be from the sale of stocks?
Mm-hmm.
Yep.
Yes, it can.
Is it too late to invest 1221 gains securities from 2018?
Depends on when the security was sold, because as you remember from my example, it's 180 days from the sale of the security. So if it was sold within the last 6 months, you have that opportunity. So probably October, November is the cutoff right now, and that's just continuing to deteriorate the longer you wait.
Okay. Do we have to be accredited investors to contribute to an opportunity zone fund? Depends on the fund, right?
Well, it does, yeah. So there's different, when we talk about funds, what often occurs is people think, all right, these are big fancy syndications where you hired an attorney and spent $30,000 to create them. No, you can create your own fund, and it's not the $30,000 bill that a syndication is going to go through. And so it's your own LLC that you create, and that is your fund that you're investing in.
Yeah, and if you're investing in someone else's fund, it just depends on how they filed it. If it's a 506c and they're advertising it publicly, you probably have to be accredited. But if you have a personal pre-existing relationship and it's a 506b, then you don't have to be accredited. But again, it depends on the fund. Let's see. I sold a property in August of 2018. Can I still take the benefit?
Yeah, absolutely you can. Because it's 180 days from the end of your taxable year. Your taxable year was December 31st, 2016. So we have until the end of June almost to roll it over. And I had the example, I gave that one in the slides.
And people who filed already, they can just set it up now and amend. Okay, mm-hmm. Great.
Yeah, if they file their tax return, if they didn't file their tax return, just file an extension, you're okay. That's why I tell people all the time, do not file on April 15th. Wait, file an extension. There's no rush.
I tell people that too, and they get really stressed out. But yeah, we always file the extension because you never know. Like you said, things can, tax law can change. Okay, Clint, are the house sale rules retroactive for a house sale on July 31st, 2018? Can one invest resulting recapture by June 31st, 2019? Some of our gain was excluded because we lived in the house in the last year and moved for employment purposes, so we would need to defer just the recapture. Does that make sense?
Yeah, so whatever gain you had on the sale of your property, because this would be a mixed-use property. It sounds like a personal residence that converted into a rental, so they couldn't defer all of their gain under 121. They had a portion that got picked up as 1231 gain. Then yes, that portion could be deferred.
Okay. Let's see. Some of these were answered already. How do I download the slides? We'll have them up on our site as well at Real Wealth, and then can they get them when they go to this?
Mm-hmm. They'll be up in a couple of days. Yeah, 2 days. They'll be up there.
Okay. If XYZ LLC has the capital gain, does XYZ LLC have to set up the qualified opportunity fund?
Yes. So if XYZ has the gain, all right, then it's going to pass through to the individual members. So the members then would turn around and invest, because XYZ does not pay taxes. Okay, it's the members who pay the taxes. So the member would take their taxable share of that investment and put it into a fund.
Okay. What if I just buy the land? What's the improvement calculation then?
Well, if you just buy the land, that's going to be new use. So you're going to have to put that you're going to have to build something on it to put it to new use, and there isn't going to be this substantial improvement. I mean, you could actually do this. You could build a shack on that property and it would qualify. They did not specify that it has to be a certain value. But what they did say is that they would look at this kind of on a case-by-case basis, essentially to determine whether or not these are people, the intent behind the investment was not to create a business. And again, when I use business, people seem to disassociate that from real estate. Real estate is a business. They want to make sure that your intent was other than just holding on to the land for appreciation. That does not qualify. You have to improve the property. So the nature of that improvement would have to be something that, is, I don't want to use this word substantial, but it would have to show that it's consistent with the intent to put the property to use, productive use.
Okay. Please clarify the 2026 date versus the 2047 date to get the 10-year tax abatement. Everyone needs to invest this year. I was confused.
Yeah, so by 2047, what happens is that is when the capital gains appreciation period ends, meaning this, that if I bought an asset today and I held it all the way through 2047, in 2047, I would have to elect to step up my basis in that asset to its current fair market value at that point in time. So if I bought it today for $500,000 and in 2047 it's worth $2 million, if I sold it that year, I wouldn't have to pay tax on any of that $1.5 million there because I've held it for 10 years. I've held it for more than 10 years, so it qualifies. But if I don't want to sell it, then I have to elect to step my basis up in 2047 to the $2 million. And so if I hold it for another 10 years in 2057, and then I sell it, and I sell it for $2.7 million, well, when I step up my basis to $2 million, that's my tax basis in this property. So from that aspect, then going forwards, the gain, my taxable gain will be the $700,000. Now, the way the law is written with this election to step up your basis without having to sell it, people have asked me, well, why would somebody ever elect to step up their basis when they're holding on to an asset and they intend to keep it for another 10 or 15 years? Why make that election today? Well, it depends on the asset. If I have a multifamily and it's producing great cash flow, if I do not step up my basis, then I can't depreciate anything. So I have no tax basis to write off against. So there may be a situation where I have this multifamily that's producing great income and all of it's taxable to me because my tax basis for purposes of depreciation is de minimis. So I may make an election to say, all right, in 2035, I am going to step my basis up to the current fair market value, so I can start depreciating that property. And I understand going forwards, if I sell it 3 years later and it's increased in values by 200 grand, I'll pay tax on that 20%, whatever. But that's built in, so it gives you some planning opportunity.
Very good. And then the 2026 date, that's just the date that you have to pay the tax on the original sale. Correct.
So yeah, so any gain that you deferred that you rolled in to a qualified opportunity zone fund on 2026, December 31st, it's all taxable to you at that point in time. Okay. So the deferral period ends on 2026. So any investment you make after 2026, and this is what's interesting here. So after 2026, because I said cash couldn't, it's only gain that can be invested. So here's where I think there is the confusion is going to lie. In 2027, if I sell a house and I generate $300,000 in taxable gain, and I rolled into that 300K into a qualified opportunity zone fund in that year, do I get any deferral? The answer is no. You're going to pay tax on that gain in 2027. So people then will say, well, why would I roll the 300 grand into a qualified opportunity zone fund in 2027 if I don't get this, tax deferral for a period of time? Because if you hold that asset for 10 years, you won't have to pay tax on it. So the benefit then after 2026 to continue to invest here is that if you invest and you hold it for 10 years, whatever gain you roll in that you've paid tax on, of course, you'll have to pay tax on your gain, whatever gain you put in, those funds, if you held them in there for 10 years in opportunity zone property, you'll escape taxation when you later sell.
Very good. Okay. And do you have time for a couple more questions, or should we wrap up?
Yeah, absolutely. Whatever you want.
Okay. All right. Would the rental income during the hold period and depreciation recapture at the end of the sale after 10 years incur tax?
So if I'm understanding it correctly, in 2026, the 1250, 1231 gain deferral will be taxable at that point in time. So at 2026, your basis in your investment will be stepped up to the amount that you have to recognize. So if I rolled in 200K of 1231 and 75K of 1250 gain, then my tax basis then will be the $200,000 or 275 is what it would be at that point in time in there, because that's how much I paid tax on.
I think what he is asking is on the new asset, the rental income that comes in during that 10-year period, that's taxable, correct?
Absolutely.
Yeah.
Oh yeah. I'm sorry. Yeah, that's all
okay.
taxable too. Correct.
Yeah. So if you sell an asset, you invest it in a qualified opportunity zone fund. It's a rental property. You're earning rental income. It's taxed. It's taxed. It's the capital gain at the end when you sell it and hold it for 10 years that is not taxed at
Correct.
the capital gain. What about the depreciation recapture?
Well, so when you talk about depreciation, there is, because you have no 1231 gain, you have no 1250 gain on the sale of that property as well. But the issue you have, though, is, how much depreciation can you actually recognize? Up until 2026, you have no tax basis in that property to depreciate unless you borrow money and increase your basis through the use of debt. So if I'm just structuring it solely out of taxable gain, until 2026, I have no benefit there. After that point in time, when I recognize my gain in 2026, that's when I'll have a depreciable asset. Again, that assumes that I put in no cash or used any debt to increase my outside basis and my partnership interest. Gets complicated. This is where you're getting in the weeds.
Yeah. Okay. We won't then.
Yeah.
The cost to create an opportunity zone fund, that's a broad question. If I were to open up a fund and take investor money, it's going to be $30,000, $40,000. But this is why I was excited to bring Clint on today's, because you could set up your own for your own properties that you purchase, and you're just opening up your own LLC like any. It's just has a little bit more reporting required throughout the years. So, and I know that your company has given our members a great deal, and I'm super excited about that. So what are we kind of looking at, generally speaking, for our members to open up their own fund?
You're looking at about $3,500 to open up the fund. And that also includes the first year tax return and the means testing of the asset itself at the 6-month and the annual basis, the preparation of the 8996 and 8949 forms as well. So it's everything that needs to be done the first year to ensure compliance, just beyond the creation of the LLC that qualifies as a qualified opportunity zone fund. So we do all the reporting as well.
So I'm so happy about that, because I've heard quotes up to 12,000, and I just thought that's too much for your own fund. Now, if you're planning on bringing in investor dollars, other people money, passive investors, and syndicating, whole different story. Then we're not talking about that. We're talking about you buying your own, having your own fund, just like any LLC that you would open. It just is a little different.
And then we don't touch those.
Yeah, you're not doing the
Nope.
securities. So be very careful. If you're taking other people's money, that's a very different deal. We're talking about your money here. Okay. What is the cost to create? Yeah, okay, we got that. All right. Well, there's a lot more questions. So I'll take another question. If you buy the same property for $500,000 cash and refi and pull all your money out and buy another property in the opportunity zone and it increases in value $1 million, I would pay no gain. No, because you have to sell the original asset. You can't just refi and take the money out, right?
Well, That's going to depend on your holding period in those assets. So what this example is that in order to avoid the gain on those properties, you're going to have to hold each of them for a separate 10-year period. So you have to track them separate. On the refinancing of that, yeah, so you're going to refinance and he's going to invest in there. Yeah, that is not going to be an issue. But you can't tack the holding period of the initial investment onto the second investment.
Okay, but you have to sell an asset to have a capital gain. You can't just refi an asset you have.
There wouldn't be a capital gain on a refi. The capital gain is going to come on the sale. Correct.
Yep, you got to sell. Yeah, so I think that's what he just. Okay, so again, more questions, but we'll just have to have another webinar another time. Or they'll just call you. Okay. All right. Thank you, everyone, so much for sticking with us this whole time. Clint, thank you. An hour and a half of your time. That's amazing. I know that's not easy for you. So thank you so much for taking care of our members again.
You bet. Flew by. Thank you for having me on.
All right. Take care, everyone. Bye-bye.
All right. Bye-bye.